Singapore, and Mikio Kumada, global strategist for LGT Capital Management. LGT has $20 billion assets under management. And Mikio, let's start things off with the Fed's comments. I had a guest on earlier, Ken Doe from Bearing Asset Management, saying it was another gift for equity traders and indeed the markets generally. I suppose you go along with that.
Yes, generally I would agree with that. It's the second gift, big gift from a central bank. We had in December a move by the European Central Bank, of course, which was very important when they lent about €500 billion worth of loans to their banks. And now we have the Fed with an unexpected movement. This shows that both central banks are getting ahead of the curve in terms of market expectations, which is a net positive, of course, for markets. We need to see now what will happen with the Chinese authorities, whether we'll see some move there in coming days. Unfortunately, expectations are building up, so the risk is that they will disappoint, actually.
Yeah, I mean, expectations always build up, and then they get dissipated very quickly when nothing happens. Is when you least expect it is when we do get some action, but we do expect some action, don't we, out of Beijing this year? What do you think they're going to do? Is it going to be triple R reductions, and then, according to many economists I've talked to, that when we get inflation down around the 3% handle, that's when we actually see proper interest rate cuts?
Yeah, I think the actual meaningful credit easing measures are probably still a bit, we need to have some more patience for that. They will do some fine trimming though, and with the momentum that's coming out of the Western economies, out of the US and even out of Europe recently, I think they have an excuse now to sit tight, because it may be too premature for them to relax too much, because China doesn't really have a problem of not having enough growth. It has a problem of oversupply in certain sectors such as real estate, and that's a bit risky to add even more credit to a situation like that. So I think they have some time now to wait.
But of course, one word that you missed out is Europe. That weighs on everything right now. And, it's very similar to 2011. But with equities, the way that they've actually been beaten down, does any more uncertainty about Europe really matter?
Well, I mean, investors, I believe, are increasingly realizing that the moves that were taken by the European Central Bank in December are actually very significant. There is a lot of money that is being pumped into the system in Europe to make sure that at the very least we will not have financial meltdown, at least not in the foreseeable future, such as, let's say, through 2012 or something. And if you remove that risk, I think the preconditions are there for a global rally, and this is actually what we're seeing. We're not giving an all clear yet. I wouldn't do that, at least, but it's looking pretty good right now.
The preconditions, not the all clear. It seems like we're at the crossroads right now.
Oh yes, absolutely. I mean, we did come from a big shock last year. We had a mini crash in August, and the markets have been digesting it quite well. And now, at least, we do see some signs, as I mentioned before, that the central banks are getting ahead of the curve and actually being, doing confidence-building measures, and that seems to be working. We need to see a little bit of more of that before we can have more confidence. But it's looking good, as I said.
Mikio, thank you very much indeed for that. Mikio Kumada.